Imagine waking up one morning in January 2021 to discover that a company founded just 6 years earlier was suddenly worth almost $100 billion, more than longtime giants like Ford or General Motors. That company is NIO, the high-end Chinese electric vehicle startup that captured the world's imagination with sleek SUVs, innovative battery swap technology, and a cult-like community of loyal owners. Investors could hardly believe that in less than 3 years, on the market, NIO had soared into the same conversation as Tesla. Yet, less than 18 months later, by mid-2022, its valuation had cratered by more than 80%. How does a company that once sat among the world's most valuable automakers collapse so dramatically? And as of mid-2025, when NIO is valued at just a fraction of its former peak, can it ever recapture that luster? To understand NIO's astonishing ascent, it helps to rewind to the very beginning. In late 2014, a handful of engineers and entrepreneurs came together in Shanghai with a bold idea: build an electric vehicle brand in China that could rival Tesla on home turf. Among them was William Li, a charismatic leader who often spoke of blue sky coming, a vision of cleaner air and smarter cars. They christened the new venture Next EV, but soon adopted the simpler, more memorable name NIO. At that time, electric vehicles in China were still something of a novelty. Overseas imports existed. Tesla had only just begun selling a trickle of Model S sedans in very limited numbers. But the domestic scene was dominated by small, low-cost city cars with limited range. NIO imagined something very different: a premium family SUV brimming with advanced technology, capable of long ranges and supported by a unique battery swap service that would let owners trade in their depleted battery for a fresh one in minutes rather than wait to charge. By mid-2017, NIO was ready to show the world what it could do. The first production model, the ES8, a 7-seat all-electric luxury SUV, rolled onto a stage in Shanghai to thunderous applause. At once, the company announced it would offer a subscription program for the battery itself. Rather than pay for the battery up front, customers could lease it for a monthly fee and snap it into a robust network of automated swap stations. That innovation struck many as a masterstroke, a way to leapfrog concerns about range or battery degradation and offer a sort of electricity on demand. Early deliveries began in mid-2018. As the first ES8s hit Chinese roads, reviewers praised their combination of long range, instant torque, and comfortable interiors. For a few months, NIO felt unstoppable. The new energy vehicle subsidies that China's government had put in place to kickstart adoption applied like rocket fuel. Buyers received generous rebates, and many local city governments lured customers with free license plates or reduced registration fees. With that kind of incentive, NIO could position itself in the premium segment while still delivering a perceived bargain compared to a gasoline-powered luxury SUV. By the end of 2019, NIO had delivered more than 20,000 vehicles. Those numbers were modest compared to any legacy automaker, but for a young startup, it signaled real traction. In 2020, demand accelerated. NIO delivered over 43,000, a big increase compared to the previous year. At the very same time, Tesla was ramping up production in Shanghai, but it still produced fewer than a few 100,000 cars globally. NIO's growth, fueled by Chinese subsidies and an ever-expanding network of battery swap stations, caught global investors' attention. The real break came in September 2020 when NIO listed its shares in New York via a SPAC merger at $8 per American depository share. By December of that year, its shares had soared past $40. Then, in early January 2021, animated by the broader frenzy around all things electric and China tech, the stock surged into the 60s. At its peak, NIO's market capitalization neared $100 billion. For context, that was roughly double the market value of BMW at the time, and more than the combined value of Ford and most major Japanese automakers. It was an extraordinary moment, like audacious bettors placing a winning streak on an upstart horse in the final furlong. Investors loved the story, a homegrown Chinese rival to Tesla, growing deliveries at over 100% annually, backed by fanatical consumer loyalty and protected by a government eager to support its own champions in the global race to electrify automobiles. Wall Street analysts heaped praise on NIO's battery swap model, viewing it as a clever way to generate recurring revenue and ensure that customers never worried about range or charging infrastructure. NIO houses, community gathering spots where owners could socialize, attend events, and get their cars serviced, were compared to Apple's flagship stores, a visible symbol of brand cult status. It all felt like a perfect storm: a visionary product, a supportive government, and an infatuated market. But as the saying goes, the higher you climb, the harder you fall. And in NIO's case, that fall began nearly as soon as it peaked. Within months, the forces that once propelled it would converge to challenge its future, and, by mid-2022, reduce its valuation by more than 80%. To understand exactly how that happened, we need to examine 4 key turning points: the tapering of subsidies, the global chip shortage, escalating competition, and a sudden collapse in investor sentiment. Each of those factors alone would have rocked the foundations of many companies. Together, they created a perfect storm that even NIO's fervid fanbase could not withstand. By mid-2021, NIO was still delivering SUVs at a blistering pace. In the first quarter of 2021, it surprised skeptics by delivering over 20,000 vehicles, roughly double what it sold in the same quarter a year earlier. But as soon as the quarter closed, investors learned that the Chinese government would begin phasing out the very subsidies that had helped drive demand for electric vehicles. This was not a secret revelation. The government had signaled its intention to taper subsidies as early as 2019, gradually reducing them year by year. But the reality felt different once the central subsidy was cut by 20% in July 2021 and set to expire entirely by year's end. With analysts cutting NIO's price target due to subsidy cutoff, the company's shares continued to dwindle down. Why did that matter so deeply? Chinese electric vehicle incentives, at their peak, effectively knocked $10,000 to $15,000 off the upfront price of a high-end SUV. When you were already selling vehicles in the $40,000 to $50,000 range, those subsidies were huge. With subsidies shrinking, buyers suddenly faced a sticker price that felt far less enticing. NIO responded by offering retroactive subsidy passes to maintain affordability. But the signal to investors was clear. At the same time, local governments that had offered additional matchback subsidies began drawing down their programs as well, meaning that in many Tier 2 and Tier 3 cities, the total incentive package vanished entirely. Buyers in these smaller urban areas no longer enjoyed rebates, and while NIO's brand had cachet in Tier 1 cities like Beijing and Shanghai, that kind of exclusivity only went so far as the domestic EV market matured. NIO's ASP, average selling price, had hovered close to 500,000 renminbi, roughly $75,000, for flagship models like the ES8 and the newly launched ET7 sedan. Without subsidies, customers could get comparably capable EVs from competitors at significantly lower price points. Average selling price is not just a number. It represents the core of a luxury-oriented business model. When that model hinged on government incentives, any fluctuation in policy immediately put pressure on margins and volumes. To keep its factory lines humming, NIO often had to sweeten deals, offering larger rebates, zero-interest financing, and extended service packages. Each of those tactics chipped away at the lofty gross margins investors had once assumed NIO would sustain. As soon as whispers of smaller quarterly deliveries began circulating among sell-side analysts, the stock's valuation multiple rapidly re-rated lower. Suddenly, a company that had been trading as if it were destined to deliver 500,000 vehicles by 2025 found itself grappling with the reality that reaching 100,000 vehicles in 2022 would be a stretch. The exponential growth curve flattened into a steep climb, causing nervousness among any who had bought the stock on the premise of higher volumes and premium prices. In short, the subsidy tapering stage triggered a cascade of consequences that turned NIO's fundamentals upside down. Just weeks after policymakers began scaling back EV incentives, a second force emerged to shake NIO's carefully constructed narrative: the global semiconductor shortage. While most of the world was busy streaming more video and buying every laptop and gaming console they could get their hands on during the pandemic, the automotive industry felt the pinch acutely. In late 2021, automakers everywhere, from General Motors to Volkswagen, began issuing warnings that production would slow because of a severe shortage of key chips. NIO, with its ambitious delivery targets, was not immune. A shortage of microcontrollers, power converters, and specialized battery management chips slowed production in NIO's factory near Hefei in Anhui province. Already contending with the subsidy headwinds, NIO now had to cope with assembly lines idled for weeks while negotiating with suppliers. In the third quarter of 2021, NIO had initially guided analysts to expect around 26,000 vehicle deliveries. Instead, it delivered just over 24,000, missing consensus expectations. The gap may have seemed modest on paper, but in the world of high-growth EV startups, missing by even a few thousand units can feel catastrophic, especially when every delivery had once been counted as a potential proof point validating that heady valuation. As the shortage dragged into late autumn, many suppliers were forced to decide whether to prioritize deliveries to legacy automakers, who represent huge, multi-year, multi-billion-dollar contracts, or to newer, smaller brands like NIO. Given that NIO was still struggling to prove consistent profitability, chipmakers often chose the safer bet. The result, NIO's production plans were regularly adjusted and unfulfilled orders began piling up. Some prospective buyers cancelled reservations after learning they would be waiting 4 to 6 months for delivery, longer than many were willing to tolerate. In parallel, China's zero-COVID policy began to wreak havoc on manufacturing hubs. When localized outbreaks flared in Anhui or in other key provinces, NIO's plants, which had only recently ramped back up after pandemic closures in 2020, faced indefinite lockdowns. In Shanghai by April 2022, the famed citywide lockdown lasted nearly 2 months, displacing thousands of gig workers, halting logistics, and creating bottlenecks not just for finished vehicles, but for essential components like electric motors, wiring harnesses, and semiconductors. The double whammy of chip shortages and pandemic-driven shutdowns meant that even while demand existed, expressed via tens of thousands of online reservations, NIO often could not fulfill them in a timely manner. Meanwhile, competitors like BYD, which owned its own battery cell manufacturing and semiconductor capabilities, mere investment arms that had quietly been stockpiling components, were able to keep production lines moving. When BYD breezed through every quarter, reporting double-digit revenue growth and consistent production, Wall Street took notice. The question on many traders' lips became, if BYD can keep rolling off cars and earn profits, why bet on NIO, which seems perpetually one step behind? Thus, by late 2021 and early 2022, the once exciting narrative of explosive growth ran headfirst into the brutal realities of real-world manufacturing, supply chain dependencies, and the unforgiving spectacle of public lockdowns. Even as NIO offered lavish incentives, free winter tire packages, lifetime software updates, and extended service warranties, to soften these woes, the chasm between investor expectations and on-the-ground performance only widened. As if subsidy cuts and supply chain disruptions weren't enough to unsettle investors, NIO now faced a third formidable challenge: a suddenly hyper-competitive electric vehicle landscape in China. In early 2021, it had felt as if NIO sat atop a small field of similarly ambitious startups. A handful of companies like Xpeng and Li Auto delivered admirable products, but none had broken through to the stratosphere of investor hype. By mid-2021, however, circumstances changed rapidly. First, BYD surged. Long known as a battery manufacturer, BYD had spent years quietly building expertise, first in hybrid vehicles, then in full electric models. By the end of 2021, BYD sold more EVs in China than any other brand, including Tesla. It did so by offering a spectrum of models, from price-sensitive small EVs under $5,000 to high-end sedans with 500 miles of range, at price points that undercut NIO by tens of thousands of dollars. At a stroke, BYD demonstrated that vertical integration, owning everything from the battery plant to the semiconductor line to the final assembly, could deliver electric vehicle economies of scale that a startup could not match. At almost the same moment, XPeng launched the P7, a mid-size electric sedan that offered a 450-mile range, under Chinese testing metrics, for roughly half the price of NIO's newly released ET7 sedan. And Li Auto, with its range-extended electric SUVs that combined a small gasoline engine as a backup generator, eliminated range anxiety almost entirely. An appealing proposition for families who spent long weekends driving outside urban cores. Meanwhile, legacy automakers like Volkswagen, GM, and even smaller players like SAIC Motor were doubling down on electric investments, pouring billions into new factories and joint ventures. NIO, which had carved out a premium niche with its community-oriented brand and battery swap infrastructure, suddenly found itself hemmed in by competitors offering cheaper alternatives and deeper pockets. To hold on to its share, NIO launched more aggressive promotions, discounted deposits, longer service warranties, and more generous financing terms. Yet, each promotion cleaved at profit margins, making it ever harder to convince investors that break-even was just around the corner. Customers who had been willing to pay a premium for a community experience and battery confidence now had more options. A well-priced BYD Tang EV SUV, an XPeng P7 with advanced driver assistance features, or even a Tesla Model Y that could be charged at the rapidly expanding supercharger network. By mid-2022, NIO's once sky-high delivery growth had flattened. In the first quarter of 2022, NIO delivered around 25,000 vehicles, a respectable number, but far short of the 40,000 or 50,000 many analysts had forecast. For investors, the writing was on the wall. NIO was no longer the sole credible premium EV brand in China. It was now one among several, and not even the fastest growing one. If you have followed any high-growth tech or EV story in recent years, you know that investor sentiment can be fragile. The same narrative that sends a stock to the moon can vaporize nearly as quickly once cracks appear in the storyline. For NIO, that shift in narrative happened at the end of 2021 and the beginning of 2022, when a stream of analyst downgrades, combined with stark stock price declines, signaled the end of the party. In November 2021, NIO reported its third quarter results, though beating revenue expectations by slight. Months later, analysts like the ones from Morgan Stanley had downgraded the stock price target. Many other analysts have also downgraded the stock, which further pushed NIO shares down. At that point, it was no longer enough to argue that NIO was just a car company. To justify its valuation, investors needed to believe in a grand narrative, that NIO would expand into Europe and North America, develop cutting-edge autonomous driving features, and monetize recurring subscription services like battery as a service. All of those pillars felt farther away once supply chain delays dragged deliveries past promised timelines, and once competitors in China began shipping cars to Europe faster than NIO could expand its footprint. Each quarter that NIO missed its financial or delivery targets, the credibility of that narrative took another hit. At the same time, a broader correction was underway in Chinese technology stocks. Regulatory scrutiny of Chinese internet giants, rising geopolitical tensions, and a global rotation out of high-growth names into safer value sectors caused a wave of selling that extended beyond auto. NIO, as a high multiple growth stock, was caught in the wash. When Tesla shares dipped in response to rising interest rate fears, NIO tended to follow suit, magnified by its smaller market capitalization and heavier reliance on narrative rather than proven profitability. By mid-2022, NIO's valuation had imploded. A company once worth close to $100 billion was now trading at a fraction of that, less than $15 billion. That re-rating reflected a sober acknowledgement that rapid growth, without sustainable margins, was not a recipe for enduring value. It wasn't merely the raw numbers, deliveries or revenues, so much as the realization that those numbers would struggle to improve quickly enough to justify the lofty price investors had once paid. The dreams of building a global premium EV brand overnight had collided with the gritty world of factory operations, component shortages, and relentless competition. By the spring of 2025, the lights that once shone so brightly on NIO had dimmed considerably, though they had not gone out entirely. The company still maintained a loyal following among its core owners, who valued the battery swap network and the community events at NIO houses. It still released compelling new models, the ET5 mid-size sedan, a more affordable entry point intended to widen its appeal beyond luxury SUVs. And it continued to roll out battery swap stations, believing that the convenience of replacing a nearly spent battery in under 5 minutes would remain a differentiator in congested Chinese cities, where fast charging often meant waiting in line. Yet NIO's financials in early 2025 painted a more cautious picture. While deliveries had climbed back to over 221,000 vehicles in 2024, an impressive figure, profit margins remained razor-thin. Competition was fiercer than ever. BYD reported more than 4 million unit sales for the year, and Tesla's Model Y and Model 3 continued to gobble market share. Even Geely and SAIC, longtime incumbents, had staked out portions of the market with their own branded electric models, often sold at price points far below anything NIO offered. Investors recognized a few positive developments. The company's all-new NT 2.0 platform, which underpinned the latest generation of ES8, ES6, and EC6 models, offered improved battery efficiency, longer range, and cost savings through standardized components. The ET7, its original flagship sedan, began rolling out a 150 kilowatt-hour battery option, achieving nearly 1,000 kilometers of range under Chinese test cycles. These were meaningful steps, but not the kind of quantum leap that would rapidly restore investor enthusiasm. Meanwhile, the battery swap network, which once promised recurring revenue through battery as a service, still struggled to reach profitability. Operating costs per station were high, and usage rates outside the biggest urban centers remained low. Customers in smaller cities simply preferred to plug in overnight or charge at the office. The world was moving toward faster charging rather than swapping, and NIO's bet on swap stations seemed increasingly out of vogue. In short, by mid-2025, NIO had stabilized from the tailspins of 2021 and 2022, but it had not returned to the sky-high growth rates that justified its earlier peak. Its market capitalization sat at less than $8 billion, a fraction of its former glory. For many observers, NIO still held potential as a premium niche player. For skeptics, it was a cautionary example of the hazards of valuing narrative over fundamentals.